Okay, welcome back to another tutorial, and today we're going to be looking at our client Barry Bobby, and I'm logged in here to the online fact find, and I'm looking at my in-progress cases. And as I can see, all my current prospects, if I look down the list, I'm going to find my client that I've been working on in the last few weeks, and what we're going to do is we're going to do some research on this client today. So if I go to Edit Fact Find, I can bring the fact find up in front of me. And what the plan will be now is to run some research on the customer, and in this case we're doing the mortgage sale. So if I go down to the research on the left hand side, I go to the mortgage requirements, and this is how we conduct our research for the customer. So what we do, really easy. First of all, we start off by adding a requirement for a mortgage, and it will bring through some of the information. Now if I've got here, I can see Barry, I'm going to put in the first applicant type. Let's say that he is a first-time buyer, and what we're going to do is the reason. So you got to just check, was it for, so is it purchase or remortgage? In this case it's going to be a purchase. What type of mortgage is it? So it's given me standard mortgage including shared equity and help to buy. So obviously with first-time buyers, that could be a good option, given that help to buy will come up as well for the properties that it applies to. You can also exclude those deals as well, or you can be a bit more specific with the ones you want to search for. So for example, buy-to-let, if it was a buy-to-let customer. I'm going to go for standard. I'm going to exclude the help to buy products just to make it a little bit easier to look at the research in the moment. Repayment method, well, you can choose between repayment, interest only, or part and part, or split. So a part and part mortgage being a mortgage that is part repayment and part interest only. Again, I'm going to keep it more simple, and usually a first-time buyer on a first purchase will probably 9 times out of 10 go with a repayment mortgage. Source of deposit. So next thing is, where's the deposit coming from? We've got builder's gift, we've got general gift, you've got loan, savings, sale of property, inheritance, vendor gifted, or equity. So let's just put in here savings, this one. And then the value of the property, so I'm going to put in the value of the property is 250, and the loan required I'm going to put in is 200. And what that does, it tells me the LTV, so loan to value is 80%, that's fine. And then we can look at the terms, so it defaults it's 25 years, but you can obviously have a discussion with the customer as to how long they want a term for. Of course, the shorter the term is the best advice if they can afford it, but you can stretch it longer if you wish. I'm going to leave it as 25 years for this purpose today. Okay, let's put a new address in. So I'm just going to put in our office address here. So as you start putting in the address, you'll find it comes up in the first line. I put the postcode in, and what you find is it comes up with the details, and then you press the address that it applies to, and it'll pre-fills the rest for you. And then you just got to complete the property details. So let's go through, and as we go along, we'll make this up for this client. But we imagine he's buying a house. It's going to have brick wall construction. It's going to be tiled roof, and we're going to say it's for his primary residence, and it's going to be a detached house on a freehold basis, and it was built in 1975, and it's got 3 bedrooms, 1 reception room, 2 bathrooms, and 1 kitchen. So trying to make it as sort of standard as possible in this instance. It's not a new build, under construction. It has a garage, yes, and it's not ex-council. Okay, so this next section is now talking about the customer's needs and preferences. So what you do as an advisor is you discuss all these different options with the customer, and you'd ask them what's important to them. You assess their attitude to risk by finding out whether they want to be able to make early prepayments. Do they want to fix their payments for a period of time? Do they want to add fees to the loan or not? And all these things, as you discuss the different options, you can explain the disadvantages and advantages of all the different possibilities. And at the end of it, the customer will give you the preferences. So I'm going to imagine that Barry, in this instance, he wants to pay his fees up front. He intends to make early repayments. Yes, he will. And if so, how much and when? So now you get a bit of free text. And what I can say is he would like to make, I can pay £100 extra per month. Okay, so what we know is those overpayments will be coming straight off to capital repayment, which will make the actual repayment period a lot less as well in terms of its time to repay the mortgage. Would you prefer to keep initial monthly outlay to a minimum? If you say yes to that, then that's going to pretty much give us the opportunity to give them a fixed rate mortgage or capped, if they even do those anymore. Would you like your monthly payments to remain stable for a period of time? Again, yes, that's going to be linking to the fixed rate part. So here we go, for how long I can put in up to 5 years plus, and let's go for 3 years in this instance. Say that's why we go Y intends to stay for at least 3 years. Okay, so just a little brief reason why you chosen 3, so make sure you explain it. Now, any other following features important to the client? So do they intend to move property in the foreseeable future? Yes or no? Do they want cash back? Yes or no? So cash back, if we want it, it'll come through. I mean, to be fair, some clients might be happy with that, other clients might not care, but it will affect their sort of fees up front, I guess, is what gives them cash back or not. The need to avoid a high lending charge, is that important? Flexible repayments, payment holidays, is that important? I put all as no's to make it simple for this instance. And then we've got the mortgage sourcing. So we're going whole of market, and we're going to go for, rather than putting all schemes in, we're going to keep it in line with their preferences. So I'm going to go for a fixed scheme and leave it at 3 years. You can include near misses as well, so it will bring up sort of mortgages that might suit the client's affordability, but just with not fitting that correct criteria. But again, we'll keep it simple. We'll say no to that one again as well. Then you've got true cost calculation. So true cost calculation is pretty cool. What it does is it actually compares all the different mortgages over the 3 year period, and it will actually calculate the overall cost. So sometimes you might have an interest-only mortgage that looks great because it's, a repayment mortgage that's got a very low interest payment, but actually it's more expensive because of the fees that are in there that are included in arranging it, and so on. So this gives us a really good way of actually calculating which mortgage has got the best value. So it's not going to be brand specific. It's literally looking at the most affordable product over that period. Now, for it to work effectively, it's a little bit confusing. When it says calculate over initial product period, we actually have to say, to make it very specific to the 3 year period, we need to say no to this. And then in there, we'll put in the amount of months we want it to be covering. So if it's a 3 year period, I'm going to say it's 36 months. And this will then help us compare it more clearer. If you say yes, what it does is the initial period might not be 3 years exactly, so it might be 3 years, 2 months for some mortgages, it might be 2 years, 8 months for others. So if you're looking at a product period, it might not be a true reflection of the actual cost when you compare each mortgage. And then if you want to include these in the true cost calculation, you can include fees payable, whether or not fees being added to the loan, you can add that in as part of the calculation. You can deduct cash back, and you can deduct refunded fees. I'm going to go for include the fees payable. I'm going to deduct cash back if that comes up. I'm going to deduct refunded fees as well. I'm not adding fees to the loan anyway, so I'm going to leave that as a no for this purpose today. Finally, loyalty products looks at mortgages that might be available to customers who currently have products with that bank or lender. Okay, so again, if you're looking at whole of market, it's not necessarily going to be your first port of call to look at that initially to get some basic quotes. So I'm quite happy where I am now. I pressed the get quotes button, and what we will see is a little bit more info. So essentially, first of all, it's brought up below the different mortgage lenders available, looking at 3 year fixed deal. And what I can see is, if I look at my filters, I can look at things based on the mortgage monthly payment. So you can look at it as being the cheapest monthly payment. I can look at that and filter that out. I can look at it the other way around as well if I want to as well, and see Bluestone coming up for the most there. I can look at it in terms of initial rate. So what's the initial interest rate, the cheapest interest rate. And I can also look at it in terms of true costs, which we said was about looking at not just the interest payments, but all the fees put together, including any deductions for cashback. So I look at a true cost calculation, then what I can see is actually now Nationwide come up with the best costed mortgage for a 3-year fixed deal, despite not having the lowest interest rate. So interesting how it works out, but it's a great way of comparing different options for the client. Now, if I want to restrict it a bit further, I can do. What I can do is I can just look at certain lenders. So I can start typing in NatWest, for example, and you can include as many of these sort of lenders as you want to. Update your results. And now we can see that in this instance, Barclays Bank come up, NatWest haven't come up at all, but it starts restricting it a little bit for me in terms of the comparison reporting. Again, just take those off to get back to all the lenders. You can look at acceptability, so if there's issues with the client's credit, you can look at what about arrears, bankruptcy, default, CCJs. If there's any other preferences they might prefer to have, so you can look at things like free legal fees, free valuation fees, no arrangement fees. If we select those ones, that will come through as part of the comparison. And then you've got the help to buy stuff in there as well. So do they want to do help to buy in this instance too, or shared equity? So there's quite a few things on there to look at, but if I update it again back to whole of market, how do we then select one to look at further? So next thing to do is to look at your outcomes here, and what I might say is, well, let's go by true cost. So I want to go by true cost. In this case, then I'm looking at possibly Nationwide, who've got a couple products there. One is a 3-year fix with a 999 fee up front, and one of them is a 3-year fix with no fee up front. But you can see that the interest rate's a little bit higher. However, it only makes £40 difference over the period of the loan over that 3-year period. So whether or not they are, whether or not one is better than the other, it's up to you. But essentially, it's 40 quid difference to have an outlay of £999. So let's say we go with the second one in this case. Then no fees. We're going to right click. So I right click on the product. And I'm going to press the shortlist button. So now what the system's doing is it's saving that information in the background, ready for me to review it. You can shortlist as many companies as you want to. So I could shortlist as well Skipton Building Society's product here, and I could also go for Virgin Money as well if I wanted to. So I've just picked the top 3 now in this instance, but you can shortlist whoever you want to. So as I can see, the mouse clicker is just doing its thing. It's saving down that information, and that's completed. So we're looking at those 3 mortgages. Now, again, I can pick just one of those if I want to. It's not a problem at all. But if I go down to the bottom, I press next, that's now going to log it in. Okay, so I'm not going to be doing any secured loans because it's a first-time buyer. I'm not going to be worrying about that. So next thing we're going to look at is we're now onto submission sheet on the left-hand side. And I'm now on here, I'm looking at the shortlists for the mortgages, and what I've got to do now is I've got to request an illustration. So I might talk to the customer about the 3 different options, and you can right click it and I can just say show details. And the great thing about that is it gives me all the links. First of all, it gives me the criteria address to go and have a look at what the lending criteria is. It gives me all the details on the product itself, and all the payments that need to be made, any fees, cashback. In this case, there is cashback here, first-time buyers, so that's good. And if we go down to stress testing at the bottom, great for our reports. We've got all the stress test amounts in there for us. We want to work it out either, so we can put that into suitability report at the end as well. So loads of little things there to look at, and you can go through this to the client rather than having to actually decide on an illustration at this stage. Let's say we're happy with that one. I right click it, I'm going to press request illustration. So that brings up your details in there. It then just asks a few questions on whether it's advised sale, declared adverse, or non-regulated. In this case, it'd be an advised sale. We can see the submission route, and we've got a proc fee come up. So this is your procuration fee for from the lender to you. And then at the end of additional fees, what we can do as well is adding our broker fees also. So I might add in a broker fee. I can see it's now arrived there, and you can either have an application fee or completion fee. So you can add in 2 fees if you're doing both. And what I might do here is say, yeah, my application fee is 195, non-refundable, and it's not being added to the loan, so I'm going to leave that off, and I can now download the illustration. No need to save it or anything. It's going to be in the system anyway. If I go to my documents page, next section, we can see it in here, the mortgage illustration, there it is, and the sourcing results. Now, if I want to just consolidate the sale, all we've got to do is imagine we have gone away, done an application for this product. At the end of the process, I come back into the system, and I just make sure I tell the system that that nationwide case, I chose it by right-clicking it and selecting the box. And now that means I can go on and complete my mortgage submission. And that's where we are going to end it today. Thank you for listening, and we'll see you again next time.